Hello and welcome. Thank you for joining today's webinar. On behalf of Questrade, I am excited to introduce you to Larry Bates. Larry is a former investment banker and author of Beat the Bank, the Canadian Guide to Simply Successful Investing. Take it away, Larry.
Thanks very much, Jeff, and thank you for watching this webinar. I hope you find it useful. I hope you're able to learn a bit and learn a bit about how you can beat the bank, which really means achieving a better outcome with your own investing. I'm going to talk a bit about who I am, why I wrote the book, uh, talk about some investing basics, why millions of Canadians are losing a shocking amount of their ultimate retirement nest eggs through fees they generally don't see or understand, and talk about practical, simple ways for investors to keep more of their investment returns where they belong in their pockets, in their retirement accounts, and to ultimately build bigger nest eggs. So first, have a little bit of fun here and consider a scenario. Let's go back 50 years to 1969. A little time travel here. That's when the Beatles were still a band. A man walked on the moon for the first time, but there was still a Trudeau as prime minister. So let's say back then, 50 years ago, you had a rich uncle who decided to put away $10,000 for you. And your rich uncle invested that money in the broad U.S. stock market, the S&P 500 index, and directed that any dividends received on that investment be reinvested in more shares. So the question is, here we are in 2019, what is that $10,000 worth today? 50 years later, what has $10,000 turned into? The answer is $1 million. So that $10,000 has grown 100-fold to $1 million. So $10,000 invested in the US stock market generally produced $1 million 50 years later. That demonstrates really the astonishing power of compounding over time. Now, think for a minute about, the market's volatile. The market goes up and down, can be a roller coaster. But what impact did the market crashes over the years have on this ultimate result? The market crash of 1987, the dot-com crash of 2000, or the global financial crisis in 2008. What impact did those market crashes ultimately have on that result? And the answer is pretty much zero. That result, growing 10,000 into $1 million, was really driven by profit growth from companies over time, and again, the power of compounding. And day-to-day market noise really turned out to be meaningless. So those short-term events fade into insignificance over time, and it's long-term investors that win. So my name is Larry Bates. I spent 35 years in the investment banking business, mostly with RBC Capital Markets in both Toronto and London, England. I had a great time. I worked with great people, and I learned a lot. I didn't deal with individual investors through my career. I dealt with large institutional investors and advised some of the most sophisticated investors in Canada and around the world. So here's a photo of me with some of my colleagues. This is back in 2003 on the front page of the business section of the National Post. It's when I was with RBC. And a great group of people. But some of my old friends are saying, Larry, what the heck is going on here? What are you doing writing a book called Beat the Bank? Well, let me tell you a little story. So my sister Mary and her husband live in New Brunswick, where I grew up. And by the way, that's not really Mary, but that might be New Brunswick in the background. But my sister Mary is real. Anyway, she and her husband worked in the healthcare industry for over their careers, and they raised two daughters. And a few years ago, they were approaching retirement, and I got a call from my sister Mary. I was sitting on the trading floor in one of the bank towers in downtown Toronto. And Mary said to me, "Hey, Larry, all we hear about is how well the stock market's doing, but this mutual fund that we own through the bank really hasn't done very much, and we don't understand why. Can you have a look?" And I said, sure. And I Googled the fund and found the fund facts document. And I said to my sister, "Do you realize you're paying 2.3% in fees?" And she said, "We're paying fees?" And I said, yeah, 2.3% a year. And she said, "Oh, you mean 2.3% of our gains?" And I said, no, 2.3% of your total principal amount, whether the market goes up or down. And if you've owned that fund for 15 years, that means 30 or 35% of your total money has been stripped away in fees. And that was a real shock to Mary. She felt really betrayed by her bank advisor. And I'm not saying that they didn't. I'm not saying they lied to my sister. No, I'm sure they didn't. But I don't think they highlighted the fees, or certainly the impact of those fees over time. And millions of Canadians are just like my sister Mary. Every penny of their retirement savings is precious, and most have no sense of the impact of the fees they're paying. And sitting up in the bank tower in downtown Toronto, I wasn't feeling very good that day. I wasn't feeling very proud of my industry. Here I was doing well and having had a good career in the banking business, and my sister is down in Brunswick, kind of getting shafted by these high cost funds, and that is what triggered me to write the book. And the title of my book, as Jeff mentioned, is Beat the Bank: The Canadian Guide to Simply Successful Investing. It was published in September of 2018 and has sold very well since then. It's designed to provide average Canadians with the basic knowledge of investing and enable them to make better decisions, and ultimately to build larger nest eggs. So let's talk about the stock market for a minute. Now, I see the stock market as one of humankind's greatest inventions. It has essentially democratized capitalism. It's enabled the average investor to become a business owner. It used to be, back in the deep dark past, owning great businesses was available only to the wealthy. But today, any investor with a few $1,000s can be a business owner. If I own 100 shares or even one share in RBC or Bell Canada or Apple, I'm a business owner. I own a little slice of that business, and it may only be a small slice, but I'm a business owner nonetheless. And I've got thousands of people going to work for me every day whose main goal is to make a profit for me, and I can just sit there and do nothing. Fantastic. And business ownership is really the largest wealth creator in the world. Business ownership is how billionaires become billionaires, and it's also how the Canada Pension Plan, for instance, earns returns to pay benefits to Canadians. Business ownership creates wealth. Now, so the stock market. There's two ways people look at the stock market or use the stock market. A lot of people look at the stock market as a trading opportunity, or looking at it like kind of like a casino, a gambling casino. Get in, buy low, sell high, get back in, get out again. Find hot stocks or hot sectors, whether that might be cannabis or crypto, or it might be oil or gold or Thailand or whatever it might be. Listen to stock tips from your second cousin, react to market headlines or economic news or political news or whatever. Most people who look at the stock market that way don't do very well. They're basically betting against professionals and trying to outsmart the market, and that doesn't usually work out very well. The other way to look at the stock market is not betting on the market, but using the market to bet on long-term business ownership. So that's what long-term investing is about, owning a collection of great companies, either directly or through a low-cost fund. Do so when you're a business owner. And of course, there'll be ups and downs in the market. It's like a roller coaster, but in the long run, that approach has always paid off. So my suggestion is take the mindset of a business owner. Business owners don't care about the market value of their company moving up and down day to day. It's meaningless. They build their business and get on with life. That's the way I think you should look at investing. Invest for the long term and get on with life. So how do most Canadians invest in the stock market? They buy mutual funds. What are mutual funds? Well, hundreds or thousands of investors contribute money to a mutual fund, which is professionally managed, and those funds are invested in a group of stocks or bonds or both. The value of a mutual fund is really an aggregation of the value of the individual components, the individual stocks and bonds in the fund. Canadians can buy mutual funds all over the place. Bank branches sell mutual funds, insurance companies and agents sell mutual funds, brokers sell them, fund companies sell them directly. So they're available broadly. $1.5 trillion, that's the size of the mutual fund market in Canada. It's huge. And 5 million Canadian households invest in mutual funds. Now, there's nothing wrong with mutual funds in principle, but the problem is most of them are very, very high cost. There are some exceptions. There are some lower cost mutual funds, but the great majority are high cost. In fact, Canadians pay the highest investment costs in the world. Most mutual funds are marketed on the basis that they can beat the market. They can figure out which stocks are going to go up and avoid the stocks that are going down and so forth. The truth is, most mutual funds underperform the market, usually by the extent of the fees that they charge. So mutual funds are marketed that they can beat the market, but again, most do not. Great majority don't. So why do Canadians buy these high-cost mutual funds? It's simply because the great majority of investment advisors tell Canadians to do just that. It makes no sense. There's an alternative out there that's growing fast. Exchange-traded funds, or ETFs. They look a lot like mutual funds. Again, hundreds or thousands of investors contribute to a fund which is invested in a group of stocks or bonds or both. They're professionally managed. And unlike mutual funds, they're not as broadly available. You need an online or a traditional brokerage account to get access to ETFs. Total size of the market in Canada is about 170 billion, which is about a tenth of the size of the mutual fund market, but it's growing fast. Now, there are various types of ETFs, tons of them being created actually, but the most well-known and in my view, the most beneficial for investors are what are called index ETFs that don't aim to beat the market, they just simply aim to match the market. And because they're very low cost, index ETFs outperform the vast majority of mutual funds. So those are the two main methods people use to invest in the market: high cost mutual funds and low cost index ETFs. So here's a question for you. According to Albert Einstein, what is the most powerful force in the universe? Is it speed of light, or is it atomic energy, or is it his mother's chili recipe? No. Albert Einstein says compound interest is the most powerful force in the universe. I tried to demonstrate that a little bit in the comments earlier about the rich uncle back in 1969. So that's a pretty impressive guy, Albert Einstein. So I think what he says is worth thinking about. But here's another quote about compounding. Jack Bogle was the founder of Vanguard, which is the world's largest provider of low-cost index funds. He just passed away very recently, but he said the miracle of compounding returns can be overwhelmed by the tyranny of compounding cost. So compounding investment costs can have a deceptively high impact on your ultimate investment results, but most people don't see it. So I created a simple calculator which reveals the impact of fees. I call it a T-Rex score. It demonstrates that tyranny of compounding costs that Jack Bogle was talking about. So you can find this very simple calculator on my website, larrybates.ca. Just 4 simple inputs, and it will tell you how efficiently your fund translates total returns into returns you actually get to keep. So here's an example. As I said, 4 inputs. In this example, we're assuming an investment of $10,000. We're assuming that this investment fund, the assets in the fund generate an annual compound return on average over the years of 8%. And you can try any number you want in there. We're assuming annual fees in this case of 0.25%, which is 0.25%, which is in line with typical index ETFs. And we're looking at a 30-year time frame, which might be reasonable for an investor in their 30s or 40s or even 50s, given lifespans. So what are the results here? There's 2 curves you can see, and they're close together in this case. The red curve represents the gain on the assets within the fund, growing at 8% annually. The yellow curve represents the return you actually get to keep as an investor in this scenario. And the score, in this case, the T-Rex score, is 93%. That means that you as an investor were able to retain 93% of the total return of the assets in the fund. The impact of that 0.25% fee was 7%. So you kept 93% of the return and lost 7% of the return to fees. So not so bad, a pretty good result. So now let's look at what might be more typical of a Canadian equity mutual fund. We're going to stick with the same $10,000 investment assumption, stick with the 8% return assumption for the underlying assets and the same 30-year time frame. But we're going to change the annual fees to be more similar to what most mutual fund investors are paying. We're going to change that fee to 2.25%. So what's going to happen? The red curve is not going to change because that's representing the return on the underlying assets. But the yellow curve, that's the amount you actually get to keep, is going to shift downwards. So, and result in a lower T-Rex score. So what do you think it's going to be? How much do you think that yellow curve is going to drop? What do you think your T-Rex score is going to be in this case? Well, there's the answer. Move the fee to 2.25%, and that yellow curve drops quite a bit. Your T-Rex score is 48%. So again, this is typical for those 5 million Canadians, and you may be one of them who invest in high-cost mutual funds. You work hard, you sacrifice to save, you risk your money in the market over your working lifetime, you trust your banker, your advisor to treat you fairly, and they strip away more than half of your total return in fees. It makes absolutely no sense. So investors would be very wise to understand what fees they're paying and what the impact of those fees is over time. And you can use this calculator to figure that out and determine whether you're keeping your fair share of fees or whether you're giving too much away. Now, a lot of mutual funds and ETFs look kind of similar. And here's an example. We're using TD Bank products in this case, and I'm not picking on TD, I'm just using these examples. This is representative of the market overall, but we've got two different funds here. On the left, the TD Canadian Equity Index ETF. It invests in large blue chip Canadian stocks. It charges fees, or in other words, the management expense ratio, as the acronym here, fees of 0.08% per year. That's less than 0.1%. On the right-hand side is the TD Dividend Growth Mutual Fund, which charges more than 2% annually in fees, 25 times as much in annual fees as the index ETF. Now, listed underneath are 8 of the top 10 stocks in each of those two funds, and you will note that they're identical. So 8 of the top 10 stocks in both those funds are the same. So given the similarity in stock holdings, you might expect similar returns in these two funds before fees. The TREX score for the index ETF would be around 98%. The TREX score for the mutual fund would be something in the area of 50%. So which would you prefer? Would you prefer 98% of the return of the index ETF, or would you prefer to end up with half the return of the assets in the mutual fund? I know what I'd prefer. And this really captures this slide really captures this sort of bizarre and I think kind of sad state of this upside down world of the Canadian investment industry. Investors who seek advice from traditional advisors and who trust those advisors will very likely be advised and told to buy mutual funds that look like this TD Dividend Growth Mutual Fund, when index ETFs that hold similar securities are available at a tiny fraction of the cost. And to me, this is it's really madness, and it's costing Canadian retirement accounts billions of dollars a year. Okay, that's all the kind of bad news. There's lots of good news. The subtitle of my book, as I mentioned, is The Canadian Guide to Simply Successful Investing. And it's based on 3 fundamental principles. The first principle is take a bit of time to learn investment basics. That's really the main message of my book. The industry portrays investing as super complicated. The message is, hey, look, this investing stuff is really complicated, it's really dangerous. Don't even bother trying to figure it out. Just trust me. And most Canadians do just that, and that's a fatal error. Take a bit of time to learn the basics, and you'll be a much better informed consumer of investment products, and you'll be able to make much better choices. And by the way, the simpler, the better. Reject complexity. The industry actually makes a strategy of complexity. The more complex the products, the more reliant you are on high fee advisors. So reject complexity, keep it super simple. The second principle is think long term. I talked about that a while ago. Take the mindset of a business owner. Ignore the noise in the market. A great example is Christmas Eve, December 24th, 2018. The stock market tanked on Christmas Eve. It was down 3%. It was the worst Christmas Eve stock market result of all time. Okay, worst of all time. 2 days later, on Boxing Day, the Dow Jones index in the U.S. was up 1,000 points. It was the single day largest point gain of all time. So what was the ultimate meaning of, the market just totally crapping out on one day and rallying like crazy the next day? What was the long-term impact of that? Nothing. It's just noise. It's just emotions moving the market up and down. Absolutely meaningless. So ignore the short-term noise. Think long-term. The third principle, and we spent a lot of time on this one because it's where most Canadians really, unfortunately, lose out so badly: minimize costs. So important. And there are great ways to invest with lower costs. And again, if you take some time to learn investment basics, you can take advantage of those other methods. So 3 methods of simply successful investing. Do it yourself, what I call assemble it yourself, and then the third method, robo-advisor. So let's take a look at each. So do it yourself investing. That really means selecting your own stocks and bonds directly. I think this approach can make sense for, let's say, 5% of investors out there, those with a bit of experience and comfort level and knowledge, for those who've had some knowledge for some time about investment basics and so forth. It's not for everybody, but it can be a great strategy for those who have good experience. But if you're going to do that, remember there are 2 ways to look at the market: trading, betting on the market. I don't recommend that. I recommend long-term investing, basically buying and holding great quality stocks, blue chip stocks. But we don't know what stocks are going up. We don't know what stocks are going down. Nobody does. Diversification is critical. You can't, putting all your eggs in one basket is very high risk. So you got to diversify across sectors and also geographically. Canada is only 3% of the global stock market, and our stock market is heavily weighted toward 2 sectors: financials as well as natural resource stocks. So we don't really have the breadth of the world economy there, and that hurts the Canadian stock market from time to time. Whenever commodity prices are down, Canada really suffers. So you got to get outside Canada. You got to invest in the U.S. market and as well the global market makes sense. You can obviously in the U.S. market you get the largest sector in the market's tech. Apple, Amazon, Google, etc., etc. You also get pharmaceuticals, consumer products, manufacturing, so on and so on and so on. You get essentially a big chunk of the global economy, and many of those sectors are high performing over time and have driven great results. So you got to diversify both by sector and geographically. Most investors also make sense to have some bonds or GICs in their portfolio to moderate the risk of more volatile stocks. Bonds and GICs generally quite low risk, and they balance the risk, the more risky portion of your portfolio that is invested in stocks. And there's a lot more about that conversation in the book. What's the right balance between stocks and bonds for you? And then, as a do-it-yourself investor, you got to keep reinvesting as long as you're not drawing funds from your investment account. As long as you're continuing to invest, you should be reinvesting, because that really fuels the magic of compounding. Assemble it yourself. You can be a very successful investor paying very, very low costs without ever having to pick a stock or a bond yourself. And that is using low cost index ETFs. I call that an assemble it yourself approach. It's also well known as a couch potato approach to investing. So, and I think it's a great alternative for millions of Canadians who own these crappy high cost mutual funds. So you can own 2 or 3 or 4 index ETFs, and it can provide a very balanced, diversified portfolio. For instance, you know, hold a Canadian stock ETF, a U.S. stock ETF, perhaps a global stock ETF, and a bond ETF. And that's it. That's all you potentially need. You rebalance those weightings once a year, and contribute your money as you see fit, and that's it. You can take a few hours a year to manage that. An even simpler approach is to consider the relatively new product that's available in Canada, and those are balanced ETFs. Those are ETFs which provide a balanced portfolio of stocks and bonds all within a single ETF, and they come in different equity bond weightings. What I mean is different stock bond mix. Let's say that you determined, well, I'm comfortable having 60% of my portfolio in stocks. I want the rest in bonds. There's an ETF that matches that. There's an ETF that matches 80-20, 40-60 the other way, etc. So that can be sort of just a one-stop ETF, beautifully simple, professionally managed. Great way to assemble it yourself and set it and forget it. And you can leave it there until you want to change that ratio of stock versus bond in your portfolio. So if you are a do-it-yourself or assemble-it-yourself investor, you need an online brokerage account. Very simple to set up. All the banks offer this service. Yeah, the same ones that sell those crappy mutual funds, but you go through a different door, you get a different product at a different cost. There are also a few very well-established independent online discount brokers away from the banks. Discount brokers will provide lots of support. They'll help set up the accounts. They'll help transfer the funds from your mutual fund provider. They'll offer practice accounts, lots of educational material on their websites, etc. But they won't tell you which stocks or bonds or ETFs to buy. You have to do that yourself. Again, it can be super simple, but learn the basics, and you'll be able to take advantage of this. And fees for online discount brokers are very low, a tiny fraction of what the traditional providers charge. So, third method of simply successful investing. Use a robo-advisor. What's a robo-advisor? Well, it's a way to invest that's very, very low maintenance, hands-off, essentially automated investing, smartphone friendly. And it's also a great alternative for, I think, millions of Canadians who could switch out of higher cost products. So go online, answer a questionnaire, a balanced portfolio matching your time frame, your objectives, your risk tolerance, your comfort level with risk will be recommended to you. And if you're comfortable with that, go forward, have funds transferred in at the outset, set up regular deposits if that makes sense, and off you go. You're set. It's an automated process. And yes, there are real humans available, and they'll provide assistance as needed. Real advisors, registered, licensed, trained advisors if you need them and when you need them. In terms of cost, there are a bunch of different robo-advisors out there, costs ranging generally from 0.25% to 0.5% plus the cost of the index ETFs they hold. So if index ETFs average, let's say, 0.2%, so total costs might range from 0.45 to 0.75%. That's more expensive than assemble it yourself, but a fraction of the cost. of mutual funds. Let's talk briefly about bonds. With today's low interest rates, you won't get rich owning bonds. Back when I started in the business, or early days in the business in the early 80s, interest rates and bond yields were double digit. You could get rich over time owning bonds and GICs, but not today. Rates are very low. So why own bonds? Why would you ever want to do that? Well, the reason is because they're great for wealth protection, and they're a great balance in a portfolio against the wealth creation, the higher risk, more volatile wealth creation side of your portfolio, i.e. stocks. And most investors need some balance in their portfolio, and it becomes increasingly important as you approach the point when you're going to start drawing down on your investments. And for many people, that's a retirement date. So good news is 3 simple ways to use bonds in your portfolio. You just simply use GICs. GICs from your bank, or you can buy GICs, sometimes quite higher yielding GICs through your online brokerage account. Good options there. And again, there are government guarantees that apply to GICs, and there are rules around those. You should be familiar with those simple rules. So most investors can have their GICs insured by the government, so it doesn't get safer than that. Also, there are great bond index ETFs out there that hold bond portfolios. They do the work for you, and they charge a very low annual fee. If you're going to select your own bonds, I would recommend sticking with government bonds unless you have a higher level of expertise and want to consider corporate bonds. But most folks don't have the expertise to buy and assess the risk of corporate bonds. So 3 simple ways to own bonds, and for many investors, it makes sense to have that wealth protection segment of your portfolio. So just to review quickly, 3 principles of simply successful investing. Number 1, the most important, and really my message to Canadians, my message in the book: take a bit of time to learn investment basics. Warren Buffett's probably the most renowned, successful investor in the world, and he said the best investment you can make is an investment in yourself. So learn a little about investing and hopefully earn a lot. You'll be well served. Second, we talked a lot about this: think long-term and ignore the short-term noise that so many people get caught up in and the media spends all their time on. Just ignore it. Richard Thaler, the economist, won the Nobel Prize in 2017. He has a great quote. He said, Rip Van Winkle would have made a great investor. He would have invested before his nap, and when he woke up 20 years later, he'd be happy. And if you own a diversified group of stocks, great companies, ignore the day-to-day noise and just live your life. Accept the fact that it's going to be volatile, and over time you'll be a winner. And then third, minimize costs. Most people don't know how much they're paying. Some people think they're paying nothing. Most people are paying way, way too much. So make sure you understand how much you're paying. Make sure you know what your T-Rex score is so that you can determine whether you're getting to keep a fair share of your return. So learn the basics, think long-term, and minimize costs, and you'll be way ahead of the average investor, and hopefully build a larger nest egg for yourself and your family. So I'll leave you with one more quote from our friend Albert: those who understand compounding earn it, those who don't pay it. So make sure the miracle of compounding is working for you and not against you. So just to wrap up, my book is available throughout Canada in stores as well as online in both print and ebook format. It's about learning investment basics so that you can make better choices, build a larger nest egg, and end up smiling more. If you want to have a sneak peek of the book, you can check out the Look Inside feature on Amazon. Uh, Sign up for my newsletter at larrybates.ca. You can also find me on the social media. So thank you so much for listening, for watching this webinar, and remember, learn investment basics and you can beat the bank. So thanks very much, Jeff. I'll turn it back to you.
Great, Larry. Thank you so much for this incredibly educational and insightful presentation today. On behalf of Questrade, speaking for myself and all our viewers, we really appreciate you taking the time to share your expertise and knowledge with us today. So thank you.
My pleasure. Thank you.
Great. Well, that concludes today's webinar. Thanks very much, Larry.
Thanks.